The Patient Architect, Lessons from the Life and Times of Warren Buffett. It's a pleasure to be with you all today to continue our series on the great minds of investing. We've spoken about hunters, pioneers, and architects of wisdom. Today we turn to the man who, more than any other, has become the public face of investing itself. His name is synonymous with long-term success, and his story is not one of fleeting genius, but of profound patience and a few simple principles, applied with unwavering discipline for the better part of a century. It is a story not of predicting the winds of the market, but of building a seaworthy vessel that could withstand any storm. His name, of course, is Warren Buffett, and while his fame is immense, the true depth of his philosophy is often obscured by the sheer size of his wealth. We see the number, the billions, and we mythologize the man. But his story is a masterclass in rationality, temperament, and the power of viewing stocks not as blinking tickers, but as pieces of a business you would be happy to own forever. It is a philosophy accessible to anyone with the discipline to learn it. He is, in essence, the patient architect who spent a lifetime not day trading, but laying one perfect brick after another until he had built a cathedral. Act 1. The Boy from Omaha and the Genesis of a Philosophy. Warren Buffett's fascination with numbers and business began not in a Wall Street boardroom, but on the quiet streets of Omaha, almost as soon as he could read. This was not a passing childhood fancy, it was an obsession. At 6 years old, he was buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and reselling the individual bottles for a nickel each, netting a 5-cent profit. He understood the arithmetic of unit economics before he understood long division. As a boy, he would pore over the stock pages, not as a curious spectator, but as a cartographer mapping a world of opportunity. He charted prices, not to find patterns in the noise, but to find discrepancies between price and value. He ran small enterprises, from selling soda and chewing gum to delivering 500 Washington Post newspapers every day. He filed his first tax return at age 13, deducting his bicycle and his watch as business expenses. The key to understanding his entire career is this: he never saw stocks as abstract pieces of paper to be traded. From the very beginning, he saw them as fractional ownership in a real business. When he bought a few shares of City Service Preferred, he wasn't buying a ticker symbol. He was buying a tiny, tangible piece of the gas pumps and pipelines that serve the nation. This foundational idea, the seam between the symbolic world of the stock market and the tangible world of business, was where Buffett would forever plant his flag. It was crystallized and given a rigorous intellectual framework when he was a young man at Columbia Business School, studying under the father of value investing, Benjamin Graham. Graham, a man scarred by the Great Depression, had developed a philosophy of profound conservatism. His mantra was to buy stocks for less than their intrinsic value, a value calculable from a company's balance sheet, thus creating a margin of safety. This was the financial equivalent of building a bridge that could hold 10 tons, but only ever driving a 5-ton truck across it. The young Buffett, an intellectual sponge, became a master of this. He was Graham's star pupil, earning the only A+ the legendary professor ever gave. He then went to work for Graham's fund, scouring the market for these statistically cheap companies, the proverbial cigar butts, discarded, unloved stocks that had 1 or 2 good puffs of value left in them. He would buy them for less than their net working capital, effectively purchasing the company for less than the value of its cash and inventories, and then sell when the price recovered. It was a method of financial scavenging, and he was spectacularly good at it. He started his first investment partnership in 1956 with $5,100. About $100 of it was his own. Through relentless work reading thousands of pages of Moody's manuals and annual reports, and a genius for finding these cigar butts, he grew that fund at an astonishing compounding rate, far outpacing the broader market. In an era where the Dow was up about 74%, Buffett's partnerships were up over 247%. He was proving, unequivocally, that the Graham method worked. He was a master of the craft, But this is only the first act of his education. He was about to learn that a cheap price for a mediocre business was a trap disguised as a treasure. Act 2. The evolution from cigar butts to wonderful castles. A pivotal moment in any great thinker's life is when they evolve beyond their teacher. For Buffett, this evolution was not a sudden rebellion, but a gradual, seismic shift, significantly shaped by his partnership with Charlie Munger. Munger, a lawyer from Omaha with a mind that ranged across disciplines, was the perfect intellectual counterpoint. Where Graham, haunted by the Depression, was focused on what not to lose, Munger was focused on what there was to gain. While Graham was fixated on buying mediocre businesses at a dirt-cheap price, Munger pushed Buffett toward a more powerful, more profound idea. Forget the cigar butts, he essentially argued. What if you instead bought wonderful businesses at a fair price? This was a revolutionary shift in perspective. A cigar butt is a cheap, fleeting transaction. You pick it up, take one last puff, and throw it away. But a wonderful business is a long-term compounder. It is a franchise, a royalty on economic growth. Buffett began to seek out companies with what he called a durable competitive advantage, an economic moat that protected them from competitors, much like a castle protected by water. This moat was the key to everything. It could be a powerful brand, like Coca-Cola, which creates a psychological moat so wide that a consumer in Bangkok or Buenos Aires would never consider a generic brown cola as a substitute. The brand itself is the product. It could be a regulatory or geographic advantage, like See's Candies had in its West Coast dominance, where its brand equity and store locations created a local monopoly on high-quality boxed chocolates. It could be a cost advantage, like Geico's direct-to-consumer model in auto insurance, which structurally undercut the costs of its agent-based competitors. Or it could be a network effect, like American Express, where the value of the card grows as more merchants and cardholders join the network. The goal was no longer to buy a dollar for 50 cents and then sell it. The goal was to buy a dollar that was going to become $2, then $4, then $8 over the next decade and beyond. He was shifting his focus from the static value of pure asset value on a balance sheet to the dynamic, incredible power of high-quality earnings that could be reinvested in the business or returned to shareholders. He famously crystallized this entire intellectual journey into a single, potent sentence. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This single idea, this Munger-inspired epiphany, became the cornerstone of his and Berkshire Hathaway's monumental success. Act 3, the Berkshire Hathaway machine and the power of float. The vehicle for this evolved strategy became, ironically, one of his early mistakes, a struggling textile manufacturer in New England named Berkshire Hathaway. Buffett initially bought into it as a classic Graham-style cigar butt. It was cheap statistically. He later called this one of his biggest financial mistakes, not because the price was wrong on a statistical basis, but because he had sunk capital into a business in a terrible commodity industry with no moat. The textile mills were a sucking machine for cash, constantly requiring new investment just to stay competitive. Yet, he turned this mistake into his masterpiece. Instead of dissolving it, he transformed Berkshire into a holding company, a platform for acquiring and holding those wonderful castles. He stopped the textile bleeding and began using its cash flow to buy what truly mattered, businesses with wide moats. A key insight that supercharged this model was his deep understanding of the insurance business. By buying controlling stakes in companies like Geico and National Indemnity, Berkshire gained access to something magical called float. This is the money policyholders pay in premiums that is held by the company until it is needed to pay out claims, sometimes years or decades later. If an insurance company prices its policies correctly and operates efficiently, it can break even or even make a small underwriting profit from the premiums themselves. But the real prize is the float. This float is essentially interest-free money that Buffett could invest for the long term. It was like a bank giving him a perpetual, zero-cost loan to go out and buy more wonderful businesses, more Coca-Cola, more American Express, more See's candies. This structural advantage, combined with his genius for capital allocation, created a virtuous cycle of compounding that is virtually unmatched in business history. The insurance operations became the engine, and the stock portfolio and wholly owned subsidiaries became the cargo, all powered by the rocket fuel of cheap, permanent capital. His management philosophy for these acquired companies is equally revolutionary and stems directly from his desire to own wonderful businesses run by wonderful people. Berkshire Hathaway's headquarters in Omaha is famously small, with a minuscule staff that could fit in a single-family home. There is no sprawling HR department, no legion of MBAs sent to synergize with acquired companies. Buffett does not manage his subsidiaries. He provides two things: capital and a culture of absolute trust and autonomy to the talented managers who run them. He looks for managers who are more passionate about running their business, who love the paint on their machines, the smell of their candy stores, the logistics of their freight lines, than they are about spending the money it generates. He finds these master craftsmen and then gets out of their way. He asks only for a single-page letter at the end of the year, and for them to call if they ever have a major problem or a large acquisition opportunity. This decentralized model attracts high-quality entrepreneurial leaders and eliminates the stifling bureaucracy and soul-crushing quarterly presentations that plague so many large corporations. He doesn't manage, he curates and empowers. The core principles, a framework for any investor. So, what are the core actionable principles that any one of us can take from this remarkable journey? They are deceptively simple, but their power lies in the disciplined execution. 1. See stocks as businesses. This is the first and most important lesson, the one he learned as a boy in Omaha. When you buy a stock, you're not buying a lottery ticket or a line on a screen that zigs and zags. You are buying a small, fractional piece of a real enterprise with employees, products, customers, and competitors. Before you click buy, you must perform a simple mental exercise. Ask yourself, would I be happy to own this entire business outright for the next 10 years, with no option to sell? If the answer is no, if the thought of being locked into this enterprise for a decade fills you with dread, then you shouldn't own it for 10 minutes. This single question forces you to think like a business owner, not a stock speculator. 2. Demand the margin of safety. The world is inherently unpredictable. Recessions happen, new competitors emerge, consumer tastes change, and managers make mistakes. Therefore, you must never pay full price for your own estimate of a business's value. Your calculation of intrinsic value is an educated guess, not a divine revelation. The margin of safety is the buffer, the discount you demand between the price you pay and what you believe the business is conservatively worth. If you value a company at 100 per share, you might only buy it at 70 or 80. This discount is your protection against your own errors in judgment, simple bad luck, or the unforeseen storms that inevitably hit every business. It is the core tenet of intelligent risk-taking. 3. Know your circle of competence. This is an exercise in intellectual humility. Every one of us has areas we understand and areas we do not. Draw a mental circle around the businesses you truly, deeply comprehend. For Buffett, that meant avoiding the dizzying rise of technology companies for decades, because he freely admitted he could not predict which would be the winners in 10 years. It was outside his circle. He stayed within his circle. Insurers, banks, railroads, consumer brands like Coca-Cola and Gillette. The size of the circle isn't important. Knowing its boundaries is absolutely critical. You don't have to swing at every pitch. As he says, it's not how big the circle is, it's how well you know where the perimeter is. The trick is not to pretend your circle is larger than it is, but to work patiently to expand it over time, brick by brick. 4. The market is there to serve you, not to instruct you. This principle is all about temperament. Mr. Market, a concept from Ben Graham, is a hypothetical business partner who is wildly manic depressive. Every day he shows up at your door and offers to either buy your share of the business or sell you his. Some days he is euphoric, seeing only blue skies ahead, and offers you a ridiculously high price. Other days he is terrified, seeing nothing but impending doom, and offers to sell you his share at a pitifully low price. Your job is not to be swayed by his emotional gyrations. Your job is to have the emotional stability to be greedy when others are fearful, and fearful when others are greedy. When Mr. Market is in a panic and selling wonderful businesses at a discount, that is your cue to buy. When he is irrationally exuberant and bidding prices to the sky, that is your cue to hold or sell. The market's wild mood swings are opportunities, not instructions. 5. Invest in yourself. The most important investment you can make, the one with the highest guaranteed return, is in your own mind. Your own abilities are your most valuable asset. They are the foundation upon which everything else is built. Buffett and Munger are walking libraries. Buffett spends about 80% of his day reading newspapers, annual reports, biographies, trade journals. He believes that the more you learn, the more you earn, because learning builds your circle of competence and sharpens your judgment. Develop the habits of lifelong learning and clear communication. Read voraciously across disciplines. Understand accounting, the language of business. Nothing compounds like knowledge. As Munger says, go to bed every night a little wiser than you were when you got up. Conclusion: the ultimate testament. In the end, Warren Buffett's story is the ultimate testament to the power of rationality over emotion, of patience over hyperactivity, and of integrity over cunning. He didn't build his fortune with complex algorithms, high-frequency trading, or macroeconomic forecasting. He built it by thinking clearly about simple, enduring business principles, and by possessing the rare temperament to sit quietly, to do nothing for years on end, while those principles did the heavy lifting of compounding. He showed us that you don't need to be a genius to be a successful investor. You do not need a finance degree from an Ivy League school or a terminal full of real-time data. You need a sound intellectual framework built on the principles of business ownership, a margin of safety, and knowing your limits. And you need the emotional discipline to stick with it through the inevitable market panics and manias. The secret has never been a secret at all. It's about buying wonderful businesses and holding them for a very, very long time. It is the relentless pursuit of quality, the unwavering demand for a price that provides a margin of safety, and the profound, almost superhuman, patience to let compound interest work its quiet, relentless magic. That is a lesson that was true 100 years ago, is true today, and will remain true for the next 100 years. Thank you.